All right, so I just sold this put on Wells Fargo, and I saw this November 2023 $50 call out there. And I said, well, when was the last time Wells Fargo was at 50? Look here, the last time it was at 50 was March, April timeframe of 2022. So I'm like, how long have I been wheeling that cost basis? So I took a look, I downloaded my transaction, I curated them a little bit just to make sure that I got all the 50s. And I think, oh, no, that's a put. Let me get this out of here. Let me delete that. Okay, so these should all be 50s, buying and selling at the 50 call. Just wheeling that, all the expirations, the dividends from that stock as well. Here's where I bought it, and it was right there, 8/4/2022. Bought at the $50. And so here's all my wheels. Here's all my call options, all the ones that expired all the way back almost a year. So the cash flow on that was $489, which is a little less than 10% over that time frame, and it reduced my cost basis to 45.1097. So since I only sell these calls at my original cost basis. This free cash flow, this 489, is all extra. So I'll buy this at 50, get rid of it at 50, and then keep this cash flow. And a lot of people say when you're trading options, and I've got this a lot, when you're trading options, you need to have like a 1-to-1 ratio of risk to reward, or a 1-to-2 ratio risk to reward. I run it quite a bit different, and if you look at my business structure videos, all the funds that I trade with are business loans, and so the 1-to-1 really doesn't work on a week to week, month to month basis when you have bills to pay, because you have bad months when you trade like that. I've had bad months trading like that. I've been in the industry 17 years, still in the industry, just not licensed. You have bad months. And when you're down 20, 30, $40,000 on any given month, really hard to pay your bills. So being up 40, then down 30, and up 80, and then down 60, or whatever your winning ratio is, I find it much better and much easier to sleep, especially when if something goes wrong, the bank's coming after me, and I have to close the business. I find it much better to trade small, pay the bills, build equity by paying off the loans, and then eventually the business is free and clear and it's all my funds. So for all those people out there that say I should be doing 1-to-1 ratios, I should be doing condors on SPX, I need to be doing, more aggressive day trading. I don't need to do any of that. I don't need to do any of that because I'm building equity in a business. I'm getting a paycheck to do so. That's how I structured it. I don't need big losses. I don't need those type of option trading strategies. So that's just a little bit into what I'm trying to do here and what I'm trying to do for the prop firm. 10% is not bad on this one position. It's 10% is 10%. The loans are far less than that. My bills, operating costs are far less than that. So this is a good strategy. It's a solid business strategy.